So today we're going to talk about the history of bear markets. Generally speaking, the definition of a bear market is a peak to trough decline of 20% or more. And so under that definition, the last bear market was from 2007 to 2009 when stocks fell significantly. We haven't had a bear market recently. We've had a couple of corrections, just barely dipping into correction territory here in 2018, down about 10%. The good news is that bear markets are relatively infrequent. Stocks go up a lot more than they go down. The longer the time frame of an investment, the more likely the market is to go higher. 53% of days, stocks go up. But 72% of years see the market go higher as opposed to lower. And it's actually pushing 90% of the time over the course of a decade, stocks are up, not down. That being said, you do see market declines. On average, once every 12 months, the stock market declines from peak to trough by about 14%. And the average length of that peak to trough decline is about 56 days. Think about it like this. What happens once per year, lasts a couple months, and is relatively unpleasant? And yeah, market corrections are a little bit like winter. If you live in the Northeast, you know that at some point it's going to snow. You don't know if it's going to snow in December, January, March, or maybe it won't snow until the next year. And when it does snow, you don't know if it's going to be 2 inches or 2 feet. But the key point is you know that at some point this unpleasant thing is coming down the road. So you prepare for it. Maybe you stock up on wine and cheese, you get a Netflix subscription, and it snows, and you know what? You're happy. Bear markets are the same way, right? People that are prepared, whose portfolios are properly allocated, well, it's still frightening because of the unknown, but having preparations in place certainly make it easier to withstand the bear. The other thing about it is that not every one of those corrections becomes a bear market. In fact, most of the time when the market goes down, it bounces up pretty quickly. Think recently, a couple examples. The Trump election. The word going into the election was if Trump won, markets were going to fall. And markets cooperated. They fell. They fell for about 15 minutes, or maybe 4 or 5 hours, recovered before trading even opened up that day. Or what about Brexit back in 2016? Markets fell sharply for about 6 weeks and then recovered and went straight onwards and upwards. So not every correction turns into a bear market. But what about those that do? Since World War II, there have been 11 bear markets in the United States. Those bear markets have lasted anywhere from 3 months to 36 months. The declines in those bear markets have been anywhere from 20% down to 57% down. The average decline is about 30%. And what about what you really care about, which is the recovery? Well, on average, it took about 6 years. When a bear market is actually occurring, you're not going to care what all the statistics tell you. Bears are scary. I mean, look at this bear on screen right now. I have young kids and I have a golden retriever. I'm thinking of trading in the golden retriever for this bear. My kids can hang out with it, watch TV, use it as a blanket. But what's the other thing you notice about this bear? Yeah, those 6-inch claws. Most of the time, markets are calm. The bear is at rest. 2017 had some of the lowest volatility in historical record. But then every once in a while, the bear takes out the claws and rips somebody to pieces. How do you know when a decline is going to turn into a bear market? I don't know. That's an open question. Maybe you have the answer. If you do, call Pure Financial. We'd love to hear from you. We're hiring. Nobody knows exactly when a bear market is going to occur or what it's going to look like. What do you do when a bear is coming? I don't know about you, I run. But in fact, a bear market may happen, it will happen, but doing nothing is generally the best course of action. So that's what you should do reactively. Winter will come at some point. That sounded too much like Game of Thrones. What steps proactively should you take to prepare your portfolio for that next bear market? Make sure your portfolio mix meets your long-term goals and your risk tolerance. If you're retiring in 5 years, you should not be 80 or 90% in stocks in all likelihood. Or at the very least, you should evaluate whether or not that's appropriate. Maybe you started off 60 or 70% in stocks or 50% and your portfolio drifted due to the long upward run in stocks that we've had. That's where rebalancing comes into effect. Set your strategic allocation based upon your financial planning, based upon your goals and risk tolerance, and then rebalance consistently to maintain that allocation. Stay the course. It's one of the hardest things to do, but you set your financial plan and your agenda in place for a reason. You shouldn't deviate just when external circumstances are the worst. Finally, hold some bonds or other safe assets in your portfolio. And again, everybody's going to be different, so this advice doesn't necessarily apply to everybody, but they're there for a reason. They're there to generate some income and to provide some stability to a portfolio. Having those safe assets cushions your portfolio in a downward market and also provides dry powder to potentially rebalance into stocks when they're on sale. Dollar cost averaging is a timeless investment principle, but that doesn't only apply to new money. The act of rebalancing a portfolio is effectively dollar cost averaging into a portfolio as stocks fall. Compound interest is your friend. Over time, stock markets go higher. The Dow was at roughly 1,000 back in the early 1980s. Today, it's around 25,000. Let that upward power, that upward momentum work in your favor by staying the course. I was listening to the podcast recently with Joe and Big Al, and they had Jonathan Clements on. And Jonathan said,
unless you think that the economy will never grow again, that we are going to be stuck here forever, we're never going to see further improvements in our standard of living, we're never going to see companies grow again, why would you get out of the stock market? I mean, the stock market in the end is a reflection of global economic growth. As long as the economy grows, the stock market will rise.
I can't think of a better note to end on, but if you do want more information on this or any other financial topic, contact us at Pure Financial. Coincident indicator. In other words, I can't say that word.
Yes, you can.
As of this recording, in May of 2018, it's at roughly 25,000. All right. Why can I not remember what to say? This is like the blooper reel.